Hi, good morning to everyone. I'm Dr. T. Radhashri, Assistant Professor in Commerce. Today we are going to say about the functional accounting, accounting for depreciation. Already we have seen what is the accounting of depreciation in the last class itself. The first method we have discussed, the straight line method. Today we are going to see about the second method, written down value method. Let me see about written down value method. What is that? What is the difference of the straight line method and written down value method? We have discussed in the earlier itself, the straight line method is the percentage of depreciation is fixed for all the years. The product or the asset, how many years we are using, the depreciation amount will be same for all the years. That is the straight line method. But when we are going to see about the written down value method, the written down value method, the other name is known as the depreciation value method also. What's the difference between of the written down and straight line method means? When the written down, the value of the depreciation is to be changed for every year. How it can be calculated? The stage of the original of the asset. When the year of using, the depreciation of the cost want to separate. You get the return on value method. The next year depreciation is calculated on this return on value method. So the total asset we can be repeating every year by utilizing the asset reach capping of the value for the useful life ends. The depreciation has a different categories we can be say. We have the 8 categories in that the written down value is the same by using the methods, but every year the depreciation percentage and the rate of depreciation is to be changed. For an example, we can say the asset is a 50,000. First, we are seeing that the first year depreciation is the 10 percentage. So when the calculation is the depreciation is the 5 percentage. So we want to do the asset real cost is a 50 percentage. For that, we want to minus the depreciation for the first year. So we get a 45,000. The 45,000 is the real cost of the first year. It should be going down the next year. In that way, the depreciation is the straight line method. For example, we can say 1 lakh, it is a 20 percentage. We will get the depreciation amount is a 20 percentage. In that way, we want to minus. How we can minus? In a 1 lakh, the first year depreciation is a 20,000. So the first year of the machinery value is 80,000. After completing at the end of the year, the real price of the machinery is a 80,000. In the next year, we want to show the 80,000 of the cost of the real machinery. The same, the 20 percentage is going. So 80,000 for 20 percentage is going means we will get a 60,000. It is the third year of the calculation we is going the 60,000. So we want to minus from the 80,000 by minusing a 60,000, we will get a 64,000. That way only the difference between the straight line method and the return down value method. The total of the minusing the product by the depreciation, we will get the final what is the real value of the machine we are calculating. That way the 50 percentage of the 10 we will get a 5,000. Now I have already say about the first year is the 45,000. So we are getting a 10 percentage. We can get of the depreciation is the 4.5 percentage. Is the written down value method. In that way, the written down value method they can be a decreasing. It is the difference of the straight line. It is a fixed. Also, we can not calculate it by the year wise years. The 1% of the amount we can put for the every year. So it is very easy and can be save that time. But return on value method we want to work out for the every year. The amount of the depreciation is differ from the total asset of the goods. It can be reducing by we will get the total amount of the depreciation. By the calculation of this we can say about the depreciation of the asset is going to be decreased. The next also we can say about the cost of the product is decreasing by the return on value method. For putting into a goods can be taken by replacing. The way of the opening is the 20,000. The by year it is going to be to have by adding the additional profit also 60,000. So we are getting the calculation of the changing by year first one and year two. We are also changing the year wise of the calculations. Thank you for listening the return on value method.